Hello everyone, we represent Georgia Institute of Technology for 2017 CQA Investment Challenge. Let me introduce the students. We have Varun Dubey, Ajay Gore, Hemant Kilampili, Xiaodong Liu, and myself Soham Nathwani. We are also fortunate esteemed mentors guiding us throughout the 3 months of the challenge. We have Mr. Pankaj Patel, who is an industry veteran, and Professor Sudhir Chava, who is the director of the QCF program at Georgia Institute of Technology. Let me introduce you to the investment philosophy that our team adopted. Our core philosophy was to long and short pair of stocks from the same industry. Our motivation behind doing so was to decrease and nullify as much as possible the market correlation of these stocks. Apart from the long short strategy, we also based our investments on the basis of market sentiments. We used bullish and bearish sentiments to go long and short on our stocks respectively. Also, we used value investing using DCF analysis as well as PE ratios to recognize undervalued and overvalued stocks and go long and short on them respectively. Apart from that, we also tried to exploit the past returns in 2 or 3 months horizon to exploit the momentum investing. In order to execute our strategy, we first started by selecting 5 broad sectors from the market. These sectors were selected on the basis of the experience and the comfort level of our team members. The securities were first shortlisted based on PE ratios. As we mentioned, for fundamental analysis, we wanted to go long on the undervalued securities and short on the overvalued securities. Also, while pairing these securities, we made sure that the volume and the profile and the industry industry profile of those companies were comparable to each other. In order to not over invest in a particular security, we decided to cap the maximum investment per security to 25% of our current portfolio value. For our initial round of investment, we had kept a time horizon of 2 weeks. Irrespective of the results of our initial investments, we had decided to wait and not alter the trades for those couple of weeks. After that, we decided to rebalance our portfolios on the basis of negative and positive results. For example, a stock that was performing according to our expectation or better would get higher weightage in terms of investment by reducing the investment in other stocks that were giving negative returns or were underperforming as per our expectations. Example of this investment strategy, let me cite GM versus Ford. We went long on General Motors and short on Ford. We used sentimental investing for this particular trade. Similarly, we longed Lockheed Martin and went short on L3 Communications. Here we used fundamental investing because we realized that Lockheed Martin was considerably undervalued, whereas L3 Communications was overvalued. Moving on from the trades, we had certain expectations from our portfolio in terms of performance. Let's talk about the risk expectations first. Because we went long and short pairing of the stocks from the same industry, our expectation was that the market specific risk would be nullified. Also, since we were selecting the securities based on the judgment calls and fundamental analysis, we had the risk of company specific or security specific uncertainty. Also, as far as return is concerned, we had little to no expectation of correlation with return with the market, whereas our only return expectation was from the discrepancy arising from the returns of individual securities which were paired with each other. After we analyzed our performance, so as far as return is concerned, you can see that in the first month, our portfolio did not perform as per our expectations and we had sub-zero returns. However, in the second and third month, we rebalanced our portfolio, refined our strategies, and we ended up with a positive result of 4.04%. For the additional risk that we took, we got a positive Sharpe ratio of 0.85. Also, since our goal was to keep the beta between minus 0.25 to plus 0.25, and since we implemented the pairing strategy for that, our resultant beta came to minus 0.1%. Also, we had a positive alpha of 1.26%. We also analyzed the risk factors that we had in our portfolio. As mentioned earlier, we wanted to negate industry risk, market risk, and style risk, and hence we had paired stocks from the same industry in order to negate market risk, and we had kept same size and same profile of those companies in order to negate style risk as well. Consequently, the factor active risk contributed only 11% of the total risk, whereas specific active risk, that is the risk based on the securities that we selected, accounted for almost 89% of the total risk. This again was in line with our expectations and with the beta that we had. Uh, that's all from our side. We hope we have covered all the important facets of our investment strategy and presented to you in the best of our capacity. Thank you very much for this opportunity.